silver vaults are draining. And I don't mean slowly. I mean at a rate that hasn't been seen in decades. So if you own silver, or you've ever thought about buying silver, what's happening right now could either make you a lot of money or cost you everything if you're on the wrong side of this trade. Here's what I'm going to show you today. Exactly why the vaults are draining, what that actually means in plain English, the one mistake most retail investors are making right now because of it, and this is the part nobody's talking about. Who's actually buying all this silver and why that should terrify you if you're sitting on cash? Stay with me, because by the end of this, you're going to look at silver completely differently. And there's something I'm going to reveal about halfway through, something about where this silver is going, that genuinely blew my mind when I first found out. Hold that thought. All right, let's start with the basics, because I want to make sure we're all speaking the same language here. When people talk about silver vaults, they're talking about the major storage facilities, places like the COMEX warehouses in New York, the London Bullion Market Association, vaults over in England, and a few other major depositories. These aren't your grandma's safety deposit box. We're talking about massive industrial-scale storage facilities that hold thousands of metric tons of silver, physical, registered, deliverable silver. The kind of silver that backs futures, contracts, that institutions trade, that sets global prices. And for the last couple of years, the inventory inside these vaults has been dropping fast. COMEX registered silver, which is the silver that's actually available for immediate delivery, has fallen to multi-year lows. At one point recently, we were looking at a significant chunk of that silver just gone, claimed, withdrawn. Now here's the twist. Most people hear silver vaults draining and they think, oh, prices are about to go up. Simple supply-demand logic, right? Less supply, same demand, price goes up. And yeah, that's part of the story, but it is not the full story, not even close. And if you stop at that conclusion, you're going to miss what's actually happening here and potentially make a really bad investment decision. Let me explain what's actually driving this. There are a few different forces pulling silver out of these vaults, and they don't all point to the same conclusion for retail investors like you and me. Force number one, industrial demand. And I cannot stress this enough. Silver is not just a shiny metal you put in a drawer and forget about. Silver is one of the most industrially useful materials on the planet. It has the highest electrical conductivity of any element, the highest thermal conductivity, and it's antimicrobial, which means it's used in medical equipment, wound dressings, all kinds of stuff. But the big story right now, solar panels, electric vehicles, the green energy transition, every single solar panel that gets installed has silver in it. Every EV battery system uses silver in its circuitry. And we are in the middle of a global push, government spending trillions of dollars to electrify everything. The International Energy Agency has said solar capacity could triple over the next decade. Triple. And each gigawatt of solar capacity requires somewhere around 1 million ounces of silver. Do the math on that. I'll wait. Yeah, the industrial demand for silver is enormous, it's growing, and it's not going away. And a lot of that silver, it gets consumed. It's not recycled perfectly. It goes into a panel on a roof somewhere, and it's gone from the tradable market forever. That's force number one. Force number two is a little more complicated, and this is where it gets really interesting, and where most regular investors get tripped up. There has been a massive shift in financial demand for silver. Not just people buying silver coins or silver bars at their local coin shop. I'm talking about institutional level buying. Hedge funds, family offices, foreign central banks, and sovereign wealth funds quietly diversifying away from the US dollar. Here's the thing you need to understand about the current macro environment. We're living in a world where the US has sanctioned Russia and frozen Russian central bank assets, where China is watching that happen and thinking, okay, if they can do it to Russia, they can do it to us. And where there's a global move, slow but real, toward assets that can't be frozen by any government, can't be printed into oblivion, and can be physically held, gold gets most of the headlines for this. But silver has been quietly moving in the same direction. And silver has one massive advantage over gold right now. It's cheap by historical comparison. If you look at the gold to silver ratio, which is just how many ounces of silver it takes to buy 1 ounce of gold, historically, that ratio averages somewhere around 60 to 1, sometimes lower. At various points over the last few years, that ratio has been 80, 90, even pushing close to 100 to 1. That means silver has been historically cheap relative to gold. Smart money notices that, and smart money has been accumulating. Now, here's the loop I opened at the start. I said there was something about where this silver is going that blew my mind. This is it. A significant portion of the silver leaving COMEX vaults isn't going to industrial users. It's not going to jewelry makers. is not even going to coin shops. A big chunk of it is going to Asian markets, specifically China and India, where it's being bought up and physically moved off the Western exchanges. Out of the Western financial system entirely. China imported a record amount of silver last year. India's silver imports have been surging, and here's why that matters. Once that silver moves to Asia and gets consumed there, industrially or held privately, it is extremely unlikely to come back onto Western exchanges anytime soon. That physical supply is effectively removed from the global tradable float. What that means is the amount of silver that can actually be delivered to someone who holds a COMEX futures contract, the registered inventory, keeps shrinking, and the ratio of paper silver to physical silver keeps growing. Let me stop you right there. Paper silver, what does that mean? Great question, and this is where retail investors get absolutely wrecked if they don't understand it. When most people buy silver through a brokerage account, through an ETF, through a futures contract, whatever, they're not buying actual silver. They're buying a paper promise, a financial instrument that says you own X ounces of silver. But there's way more paper silver out there than there is physical silver sitting in vaults. Some estimates put the ratio of paper silver to physical silver at 100 to 1 or higher, which means for every 1 ounce of physical silver sitting in a vault, there are potentially 100 different people who think they own that ounce through some kind of paper instrument. Now, most of the time, this doesn't matter. Most people never actually try to take delivery of their silver. They just buy it on paper, hope the price goes up, sell it on paper. Fine. But here's where it gets crazy. If enough people, at the same time, decide they want actual physical delivery of their silver, the math doesn't work. There's not enough physical silver to go around. And that's a very different situation when vault inventories are already at multi-year lows. Here's the deal. I'm not saying a silver squeeze is imminent. I'm not going to hype you up with some silver to the moon nonsense. What I am saying is that the structural setup, low physical inventories, rising industrial demand, institutional accumulation, silver moving to Asia, creates a situation where any spike in demand for physical delivery could create real dislocations in the market. And here's the question I want to ask you. Have you actually thought about what form your silver exposure is in? Because this is the number one mistake I see retail investors making right now. People hear silver vaults are draining and they rush out to buy a silver ETF. And look, I get it. It's easy. You just click a button in your brokerage account and you're in silver. But depending on which ETF you buy, you may own something that is settled in cash and not backed by physical silver at all. Or you may own shares in a fund that has silver, but you personally have no right to ever take delivery of that silver. If the physical market gets squeezed, if there's a divergence between the paper price and the real price of physical silver, an ETF may not track perfectly. And in an extreme scenario, you could be holding paper silver during a physical silver shortage and not even be able to benefit from it properly. Most people miss this. Most people just assume that owning silver means owning silver. It doesn't. Not always. So what should you actually do about all this? Let me give you a real framework here. 3 different approaches depending on your situation and risk tolerance. Approach 1, physical first. If you believe in the long-term silver thesis and you want actual exposure to physical silver, the most direct way is to buy it physically. Coins, bars, whatever. You can buy from reputable dealers like APMEX, JM Bullion, your local coin shop. You take possession of it, you store it. It's yours. No counterparty risk. Nobody can freeze it. No platform can go down. No paper game can mess with it. The downside? Storage and security become your problem. And you're paying premiums over spot price to buy physical silver. And those premiums have been elevated lately because, wait for it, physical silver demand from retail investors is high, which is actually itself a signal that smart money is paying attention. Approach 2. Allocated, physically backed. ETFs. If you want the convenience of ETF ownership but want better exposure to physical silver, look specifically for funds that hold allocated, audited physical silver and in which shareholders have some form of claim on physical metal. The biggest example in the US is SLV, iShares Silver Trust. But you should actually read the prospectus, not just assume. There are differences between funds. Approach 3. Silver mining stocks. Now, here's an interesting angle. When silver prices go up, silver mining companies often go up even more on a percentage basis. That's because their profit margins expand dramatically when the metal price rises, but their costs stay roughly the same. A silver miner producing silver at $15 per ounce and selling it at $25 makes a certain margin. If silver goes to $35, that same miner's profits can double or triple. That's called operating leverage, and it's why mining stocks are sometimes called silver on steroids. And this is a big but mining stocks come with their own risks: management quality, geopolitical, risk if mines are in unstable countries, production issues. The stock market can drag mining stocks down even when silver is going up. They are not a simple bet. Real talk. I've personally made mistakes owning mining stocks in the past, thinking I was buying cheap silver exposure, and then watching the stock underperform even when silver did okay. You have to do your homework on the specific company, not just the metal. Now here's something I want to address because I know some of you are going to be thinking it. If vaults are draining and silver is so bullish, why hasn't the price exploded already? This is actually one of the most interesting questions you can ask, and the honest answer is, it's complicated. Part of it is that silver's price is still heavily influenced by the paper market, those futures contracts. And in the short term, big institutional traders can push the paper price around in ways that don't perfectly reflect physical supply and demand. That's not a conspiracy theory. That's how commodity markets work. The futures market serves an important economic function for hedging, but it also means short-term price can diverge from physical reality. Part of it is also that silver is a small, somewhat illiquid market compared to stocks or bonds. A relatively small amount of money can move it dramatically in either direction. And part of it is that we're in an environment where the dollar has been relatively strong, and a strong dollar tends to suppress commodity prices that are priced in dollars. When the dollar weakens, and over a long time horizon, given U.S. debt levels, many analysts expect it to, commodities priced in dollars tend to rise. But here's the thing, the structural story doesn't require a specific catalyst or a specific timeline. It just requires that at some point, the math catches up. You can't have infinite paper claims on finite physical metal forever without something giving way. Here's where it gets interesting for you specifically as a retail investor. You actually have some advantages that institutions don't have. You can take physical delivery. You can walk into a coin shop today and buy silver. You can have it in your hands tomorrow. Large institutions can't do that at scale without moving the market significantly. You have a long time horizon. You're not running a hedge fund with quarterly redemptions. You're not forced to sell. You can hold through volatility. You don't have to disclose your positions. Nobody knows what you're doing. You can accumulate quietly. And you have no minimum position size constraints. You can buy one Silver Eagle coin for like $35, and that's a legitimate position. Hedge funds can't operate that way. These advantages are real. Don't underestimate them. Now let me be really honest with you about the risks here, because I'd be doing you a disservice if I made this sound like a guaranteed slam dunk. Silver is volatile. It can and does drop 30, 40, 50% in bear markets. If you're the kind of person who would panic sell at a 40% drawdown, then a concentrated silver position is not right for you. Know yourself. The green energy transition, while real and ongoing, could slow down or shift in ways that change industrial demand dynamics. Technology could develop substitutes for silver in some applications. These are real risks. And the draining vaults thesis has been discussed in the silver community for a long time, like longer than I'd like to admit. Markets can stay irrational longer than you can stay solvent. That's a quote from Keynes, and it applies here. Being right in the long run doesn't help you if you're leveraged and you run out of memory in the short run. Never put money into silver or any hard asset that you cannot afford to lose or to have locked up for years. This is speculative. It should be a portion of a diversified portfolio, not your entire net worth. Having said all of that, the structural case for silver right now is stronger than it's been in a long time. The combination of industrial demand tailwinds, monetary demand, draining physical inventories, and historical undervaluation relative to gold makes for a genuinely interesting setup. And if you're someone who's been watching the silver market from the sidelines, wondering if you've missed it, here's the honest truth. Silver at whatever price it is today is still below its all-time high from 1980 when you adjust for inflation. In real terms, the metal that powers solar panels, electric vehicles, medical technology, and is being accumulated by the smartest money in the world is still cheaper in real purchasing power terms than it was 4 decades ago. Make of that what you will. Let me bring this home. Here's the core of what I want you to take away from this. Silver vaults are draining because of a combination of real industrial demand, driven by the green energy transition, institutional financial buying, and a global move of physical silver toward Asian markets where it may not come back. The ratio of paper silver to physical silver is enormous. That creates a structural vulnerability in the market. If you want real silver exposure, know what you actually own. Physical, allocated, or paper, and understand the difference. You have real advantages as a retail investor that institutions don't have. And the long-term structural case for silver is genuinely compelling, even if the timing is unpredictable. So here's what I want to know from you. Do you own physical silver? Or are you in paper silver right now? Drop it in the comments. I read every single one, and I actually want to know what you're doing because it helps me make better videos for you. If you found this useful, hit the like button. It genuinely helps this channel more than you'd think, and it means YouTube shows this to more people who need to hear it. And if you want to keep getting content like this, where I dig into the stuff that matters for regular retail investors and don't just repeat the same surface level stuff you can get anywhere, subscribe. Because the next video I'm working on is about something very few people are talking about. What happens to silver-backed financial instruments when physical delivery demand spikes, and what that means for your portfolio. You don't want to miss that one. The vaults are draining. The question isn't whether that matters. It's whether you'll be positioned before the rest of the market figures it out.